Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. Hello, David. Did you actually manage to get any sleep on election night?
Hi, Sarah. Hello, everybody. I got some sleep. I think that's the way I'll describe it. About 2 hours.
Yeah, probably if you compressed all the time that I wasn't listening to election results, it probably was about 2 hours as well. But anyway, it was riveting stuff.
I was extremely chilled out late in the evening thinking I'll just stay up until Georgia was announced. And then 4.5 hours later, I was still glued to the TV.
Okay. Well, I think we know what we're going to be talking about today. We're going to be talking about the US presidential elections. Before we get to that, quick fire numbers round. What's your quick fire number?
Well, I'm keeping it on topic. I know that's not normally the case. It's not customary. We should do these esoteric numbers. Mine's on topic. So mine's 131, which is the number of years since we last had a president who lost office and then subsequently was re-elected. And bonus points if you know which president that was.
I do know, because that's actually my quick fire numbers round. Well, great minds think alike. Or
so
as my mother would say.
We've got a quick fire snap. Okay, so you do know.
Well, my number's 1893, which was the last time we had a non-sequential second term from a president, and it was Grover Cleveland.
It was Grover Cleveland. There we are, listeners. Just if you ever wanted proof that Sarah and I don't tell each other what our number is, you have it there.
I know, because it seems incredible that this is only the second time we've had a president serve 2 terms that were not right next door to each other.
Exactly. Grover Cleveland, of course, famous for his vetoes, the veto president, vetoed everything.
Okay. Is that why he lost his first attempt at a second term?
Well, actually, that's a much longer story. Well, let's keep it more contemporary, shall we?
Exactly. Let's bring it right up to date, because there's quite a lot to digest from the result, which I guess kind of slightly took everyone by surprise in the swiftness of the result. But breaking it down into sort of 3 topics, what do you want to talk about, David?
I think that's right. I think it took everyone a little bit by surprise. But then in the hours running up to midnight last night, I think it sort of came to me in an epiphany that actually it was going to be quite a decisive result. And here's why. So this is how I'll relate that back to the 3 things today. Let's talk about the polls and the issues with polling as we went into this election. And there is a little dot to dot we need to do from 2016 to 2020 to last night to sort of understand the issues with polling. And then let's look at then what the exit polls tell us of why people voted the way they did and what that means in the context of economics. Because I think there's a glaring economic statistic that I think has overarchingly driven this result. And we'll talk a bit about that. And then shall we talk a bit about the US growth story and economic and market story insofar as it just transcends electoral politics?
Yeah, exactly. I think because, obviously there's now a sharp focus on markets, and we can then sort of put all that into context. Okay, then let's kick off with polls, because I know we've talked on previous episodes about the struggle that pollsters have in getting really representative groups to talk to, and the fact that people don't like responding to polls in the first place. So is it fair to say, because I think a lot of the polls, well, my understanding was a lot of the polls were saying this was going to be really, really tight. It was going to go right to the wire, and it was going to be days before we had a clear result.
Yeah, I think there's 2 ways of looking at that. The first way is the slightly conspiratorial way, which is that perhaps nobody knew and pollsters want to hedge their bets one way or the other. And the other way more is about, I think, by construction, how these polls have been built since 2016 and then 2020. Now, I did dig around to try and just understand how big the global polling business is. It's tricky because many of those polling companies are also big consulting firms. But the estimate I came to is, and it is an estimate, is around sort of $130 billion revenue business globally, or industry, sorry.
Okay.
So it's big money in polling, and getting it right is obviously important. Otherwise, why would you bother? And pollsters had a real bloody nose after 2016.
Yeah.
And then some more embarrassment, I would say, after 2020. Because in 2016, they massively underestimated the Republican support.
Yeah.
Right up to the eve of the election, to the minutes before the election, Clinton was the assured winner as far as every pollster was concerned. And then in 2020, they again, got it wrong. They basically overrepresented Biden support. So it wasn't quite as landslide as they predicted in 2020. So what the pollsters have done incrementally over the last few years is they've made adjustments to the methodology, and there's three major adjustments they made. The first one was to try specifically and capture Trump's base. What they did is they were after polling non-college educated rural voters in those key states like Pennsylvania, Michigan, Wisconsin. And the issue, as we've discussed before, you and I, Sarah, with polling, is finding a representative sample now is incredibly difficult, because what do you do if your phone rings from an unknown number in the middle of the day? You tend not to answer it. In fact, there's a whole generation of young people who just aren't answering any phone calls at all.
Yeah.
They're living their life, through different digital media. So it's very, very difficult for pollsters to tap into that Republican base. So they started to adjust their polling to align samples more closely to recent electoral outcomes. So what they do is they do this thing called weighting on past vote. So they say you voted one way last time. Well, this cohort, this county, this cross section voted this way last time, and therefore my polling response is saying X. I will now adjust it based on how a similar cohort in the last electoral cycle voted.
Okay.
So that helped, I think, a bit. Then you obviously in 2020, the big problem there was pollsters had no playbook for how you model polling in a pandemic. That was a big issue in 2020. It was a unique challenge. So you had many Democrats staying at home, and they were much more likely to respond to polls. And then, of course, Republicans, again, who were out and about, who voted on the day, tended not to respond. And then you had that overrepresentation of Biden support that I mentioned.
Okay.
And then the third and final point, which is more about, I think, the economics of the polling industry, it was just a fear of overcorrection. And there was quite a lot of manual intervention in certain counties and certain states, because pollers remember that trauma of 2016, that surprise Trump victory. So they literally adjusted some of those polls almost qualitatively to what they thought represent better that Trump base.
So it sounds like you're saying then that they didn't really get it wrong this time round. I mean, they were predicting a close election, but are you saying there was enough of a margin of error there that actually they were kind of right?
Yeah, well, per se they didn't get it wrong, but we were left into yesterday evening with an answer from polling which suggested it could go one way or the other. It's a coin toss. But I think this is interesting. If you go back and look at elections over the last couple of decades, you see that polls are normally off by about 6 percentage points compared to the final result. In 2022, the last time we did some decent, polling in the midterms, the margin of error was much narrower. It was around 5, percentage points. That made 2022 one of the most accurate cycles in recent history. Okay. If you took 2022's accuracy as your baseline and then applied it to what pollsters were telling us last night, you were well within the margin of error. So what I'm saying is that it came to me in like an epiphany last night that actually we're going to get a decisive result either way.
Yeah.
And that's what happened. And I think the way I'd sort of represent the Republican victory is a decisive victory. I wouldn't call it a landslide, and you can dissect the numbers to kind of make that point. And clearly, as we record this, the president is clear, the Senate is clear, and then similarly to 2020, county by county, seat by seat, the House is going to be very, very tight. But it is well within the realms of possibility we get a complete sweep.
Okay. What's interesting then, perhaps to sort of go back now to look at the result, is what the exit polls told us, which are obviously a very different thing altogether. But because we talked previously about the importance of, the swing states, particularly Pennsylvania, and how tariffs were a really, really important topic. But from the exit polls, what did that tell us about what was motivating voters?
Okay, well, before I get onto the exit polls, indulge me just one more minute to talk about polling, because obviously professional polling and the polling industry is one thing, but then you also have the betting markets, and you have other ways of gauging opinion or gauging a view. What I thought was interesting yesterday and surprising actually was the popular vote. So the betting markets, they jumped from around 25% chance that Trump would win the popular vote to a 99% chance within minutes. And at no point before election day were the odds more than about 45%. So that, I suppose, is giving the pollsters a little bit of credibility, saying that, well, even the betting markets weren't getting this one right. I just think by construction, it was more likely to be one way, decisive issue one or the other. Right, your question about exit polls, which is, I think, the key takeaway from last night. So exit polls, as they started to come out, and as I think we were getting a steer for which way this was going, there were a number of questions that were asked to people as they came out, and many of those were sort of ideological questions, which we won't discuss in our markets podcast. But I think the key takeaway from that side of the questioning was that America has moved to the right. The bit that is interesting, I think, is there was two common themes that came out again and again and again, and it's that voters were very angry, upset, concerned about two things: about the cost of food and about the cost of housing. Sorry, not the cost of food, actually, the cost of gas and the cost of housing. And I think that itself is probably the key takeaway insofar as it relates to why people have voted the way they did last night.
Okay, which brings us then very neatly on to our second point, inflation. Now, the Fed has started cutting rate. Inflation's coming down. Why is this still a hot topic for voters?
So 48% of those voters in those exit polls expressed anger about gas prices. 52% expressed frustration with housing costs. The Fed tells us that inflation is coming down, but those of you, again, that follow me on LinkedIn will know I posted a very good chart. It's a John Author's chart from Bloomberg that talks about the anti-core inflation basket. Okay, and this has hit a number of people, I think, over the last couple of months, that there is this disconnect between how people and how voters experience inflation and view inflation, and then what policymakers, technocrats, say inflation is. So, first of all, why is inflation important? If you go and look at different electoral cycles, inflation is amazingly important. So in the US, because we're talking about the US election, there's plenty of academic evidence and studies that show that one of the principal reasons why Carter lost was inflation. There's even more evidence, I would say, in emerging markets and their sensitivity to inflation in election years. So you can see in the Journal of Development Economics that they've looked at elections in Argentina, Brazil, and Turkey, and it directly affects political stability. And again, let me give you another example. In North Africa during the Arab Spring, if you look at the political instability that was generated there, it was effectively because of food prices. That's what started that. And when you look at people's consumption basket, and if there's a high proportion of that basket that has seen big inflationary pressures, well, that's then what drives behavior. So when central banks look at our consumption basket, they strip out things that are volatile. So gas prices, food prices, they have different ways of assimilating housing costs that smooth volatility. But you could argue as a voter that's not necessarily representative of the inflation that you have experienced. And central bankers are obviously concerned with the rate of inflation, the rate of change. Voters are concerned just of how much things cost, the level. So what you saw, if you go and look at inflation, and if you look at this anti-core inflation basket, which is basically a basket of energy costs and food, you see a spike like we haven't seen since about the 70s during the oil price shock. And then if you look at just food prices over the last decade, you can see you had this gentle, modest appreciation in food prices in line with a modest inflation rate. Then you saw this massive 2022 shock, post-pandemic shock actually, and then a return back to the trend. But the point is, things don't get cheaper; they just grow at a diminishing rate, or not a diminishing rate, at a rate slower than what they were. So central bankers claim victory and say the rate of inflation growth has slowed back to trend, but it doesn't take that baseline price rise back down. Things don't get cheaper. So you've got this body of academic evidence that suggests that inflation is the most important thing. and you've got this disconnect between what policy is focused on. And I'm not, by the way, I'm not suggesting that policy should be focused on the volatile parts of inflation, because that would be counterproductive. I think what I'm suggesting is that if you run a narrative as a technocrat, as a policymaker, that suggests that inflation has fallen, if you're a voter or or just an individual in the economy, and you go to the petrol station, you go to the supermarket, you can kind of understand why people can't reconcile those two things they see, the narrative they hear and the price they pay.
Because the trouble is, you hear about, as you say, you hear about inflation coming down, and to the casual listener, you think that means prices are coming down. But that doesn't mean prices are coming down. It just means the rate at which prices are going up is coming down. Prices are still going up. And as you say, the important things that we all have to buy, whether they're in a core metric or not, is irrelevant. We all have to, well, most of us have to put petrol in our cars, and we have to buy food, and we have to heat and light our homes.
Absolutely. And I think I'm suggesting that we probably need two different measures of inflation to be able to articulate that narrative in a clear way. There is also the behavioral economic side of this, and there's been lots of studies on this, that actually perceived levels of inflation are often higher than measured levels of inflation. So if you ask people how much prices have gone up, they'll tend to overestimate it. But look, I mean, that's very much at the margin. There's no way of escaping the price shock that we've had over the last few years. Yeah. And I think policymakers, by starting, and I was very much in this camp, that this was a price shock and this was transitory, because ultimately all inflation is transitory. I don't think transitory perhaps represented how long the price shock would persist. And also didn't help people, I think, understand the nature of the price shock. And that was really relevant, I think, as we went into this electoral cycle.
Okay. Well, let's come then now, let's focus on the US economy and market, and so market reaction. I guess before we talk about the sort of broader picture, I think it's probably fair to say that it wouldn't really have mattered whether it was a Harris win or a Trump win. Markets are just glad that we've got a clear, decisive win and a smooth transition of power.
Yeah, I think that's right. Markets don't like uncertainty, right? That was if you go back and look at, there's not many examples, unfortunately, and we talked about this briefly on the last podcast. On the October 15th podcast, when we talked about the US economy in some detail and what might happen. It was the period between election night and December 2000, the last time we had a protracted period where there was no result. And in that period, I believe the S&P sold off in the order of around 12%. And that's simply uncertainty kicking in. So you're right. The result itself, actually, the market moves today reflect that a lot of this was probably priced in. And remember, the stock market isn't the economy, though. And we keep coming back to that point on the podcast. Trump's victory was largely priced in, because politics generally affects markets much less than you think. Okay, so that's my it doesn't really matter point, and and no one really has a clue what the next presidency, what the next term is going to be like, what policies are going to come in. There will be a process and a sequence of events that will then reveal that to us. So if you look at the markets today as we record this, okay, equities are rallying, and it's unsurprising that those stocks that were very close to the Trump campaign, the Republican campaign, are rallying very significantly.
The so-called Trump trade.
The Trump trade, exactly. Yeah. And certain sectors which, through Trump's various public speaking and rhetoric, he seems to favor, are obviously doing quite well. We know, though, that this is just one day, and there are when we look at the performance of the US market on aggregate over time, it is not individual short-term policies that drive it. It is long-term productivity. It is global economic growth. It's global trade. It is technological progress. There are lots of global macro factors that drive US equity returns, not necessarily short-term policies. Nonetheless, stocks are up. But that doesn't mean the economy is healthy necessarily. It's just pricing in government policy that is perceived to favor the interests of one particular sector or parts of capital. By the way, the US economy right now is very healthy, and that kind of explains the pathway of equities over the last 12 to 18 months. The other side of this, of course, is the bond market. And I think that's the most important number today. And if you go and look at bond yields, which are inverse to the price of bonds, they've jumped effectively to 4-month highs. Why is that, you would ask? Well, the bond market is now simulating possibly higher inflationary environment. Now, we talked about this on October 15th. We talked about the effect of tariffs and what exactly what tariffs would do to inflation. And there is some clear modeling that shows, depending on what tariffs are brought in, whether you've got at the extreme a universal tariff on everything, or perhaps more targeted tariffs, you get slightly different inflationary outcomes. But resoundingly, tariffs are inflationary, which I think that's the apparent contradiction, right? With the exit polls, voters are concerned about inflation, tariffs now potentially on the cards and inflationary.
Yeah. Do we see then this having an impact on Fed policy? Obviously, the Fed is independent, but is this going to change their approach to rate cutting? Are they going to continue at the same pace as they were? Are they going to have to take note if they see inflation ticking up again? Are they going to maybe slow down, fewer cuts? Do we know?
Yeah, so a few different factors at play here. And I would encourage people to go back and listen to the other thing we talked about when we talked about debt on the podcast. So you've got, first of all, the Fed's data-driven mandate. Jerome Powell is always saying we'll be led by the data. So we have a Federal Open Market Committee meeting tomorrow, and a cut is priced in. I would expect that to continue, okay? Because the Fed will be responding to the data. Then what will happen next year. We'll get the policy agenda revealed to us, and that will have whatever impact it will have. And then the Fed will respond to that, again, in line with the data. Now, the Fed, within its remit and its previous behavior, might anticipate and try and get ahead of certain policies if it feels they are intrinsically inflationary from day one. But I think what I'm saying is it's going to be business as usual for the time being.
Yeah.
The Fed will be cautious. It will watch, observe, and then react. So, there's a few other things going on as well. Obviously, we know Jerome Powell's tenure is up as Fed chair. The president-elect, I think, has the ability to select certain Fed roles in the period between now and January. But I would expect business as usual for the time being.
I was going to say, and obviously, as you just mentioned, the new president, he isn't inaugurated until 20th of January. So nothing major is going to happen between now and then. And then, assuming he does introduce some legislation around tariffs or additional spending or tax cuts, we're not going to see that until, I don't know, when would we expect to see that? Q2?
Probably Q2 earliest next year. Exactly. Yeah. And I think that so the bond market's reacted today as if inflation expectations have increased. So you've seen the 10-year bond yield jump to a 4-month high. That would signify that the bond market is assimilating the idea of tariffs, perhaps more borrowing, certainly more spending. But we don't know yet. Okay, so again, the market will adjust accordingly. There's other things at play, though. So today, there's been an auction of 30-year Treasury bills, which, these bond markets, as you and I discussed, are inconsistent with their liquidity, let's say. Well, actually, no, I'll just say it. They're quite illiquid. And even big markets like the US Treasury market can at times be quite illiquid, which itself is an issue which we talked about in terms of how debt is rolled over and how this wall of debt needs to be refinanced over the coming years. So you've got inflation expectations being assimilated. You have illiquidity in the market, and I think there's lots of forces at play here. But the Fed has been really clear, I think, with its signaling that it will be driven by the data. Don't expect any change tomorrow. And I think what you'll see is just now a period of being more cautious and watching, and maybe if the policy mix is more intrinsically inflationary next year, they might even get ahead of that and get ahead of that. But as we're here today, I'm not seeing any real change. So I think the market reaction actually is broadly priced in. There's a few other points. I mean, the move in the dollar, I won't labour the point, is more because of where yields are. Again, currency markets inherently fickle. Listeners, over short periods, I wouldn't read too much into that. They tend to adjust over the long run, more in line with what happens with trade and what happens with economic growth. The dollar actually, over the last 50 years, has been an incredibly weak currency. That's why it's the global reserve currency. In fact, we are living through a really peculiar time where we've got acute dollar strength. So I think we watch this space when it comes to that. So all in all, I would say quite a calm reaction by markets.
Yeah. And as you say, they've still got, they need time to fully digest this. I mean, there's been an immediate reaction, but I think what I'm getting from you is that the US economy is strong. It's outpaced its peers. I think we had a discussion before, since 2018. Whoever is the president is not going to fundamentally change that, because your team have done the research into that. We know that ultimately investment returns are relatively similar, whether it's a Republican or a Democrat president, doesn't really make a difference. But it will certainly be an interesting couple of months to see how markets kind of adjust, and we see what kind of policies are going to be introduced.
Yeah, and you're 100% right. So the team here at Coutts have looked at 150 years of different presidents. And we did a deep dive on the different styles of presidents and the different global geopolitical backdrops that those presidents operated in. Republican and Democrat alike, the result for markets is broadly the same. Once you strip out of inflation, which varies under different periods, you end up with approximately just over 7% annualized return in US equities, irrespective of party. So there's no reason to think it's going to be different this time, having had 150 data set. And I know many listeners might find that idea, they might want to challenge that idea, but I would focus on, again, the stock market isn't the economy, isn't the US economy.
Yeah.
Many of those firms that are listed in the US exhibit just such consistent earnings growth, and they have done over the last decade, and specifically since 2018, and they're global firms. And if you go back and look at a GDP chart, again, I posted one on LinkedIn. If you look at normalized GDP, you can see that the US was relatively ahead of Europe and UK over the last decades, but modestly ahead. And then in 2018, it started to really accelerate ahead, and post-pandemic, even more so. So there is a very dynamic economy there at full employment that is embracing technology, it's a global leader in AI. And I would just, I know everyone has got some very strong views about this election who are listening to the podcast, but I would just focus more on the data, the markets, and the fundamentals. And there's no reason to believe that ability for the US to generate consistent, reliable earnings growth is going to change overnight.
Yeah, focus on the fundamentals, because that's what markets are going to do. Is that what we're saying?
Exactly.
Yeah. Okay. Thank you very much, David. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. We talked about that episode from the 15th of October, where we talked about ideology or earnings. What is it that drives markets? This is a subject that David and I have talked about a lot on previous episodes, so go and check those out. Also, draw your attention to last week's episode, where I had a catch up with Arian Wolstenholme, Head of Wealth Structuring at Coutts, to talk about the budget and the key takeaways from the budget, what they did do and what they didn't do also. Until next time on Need to Know, bye for now.